Did you see Antonio Brown walk off of the field?
That was absolutely... I've never seen
jog off
anything
the
like
field?
that ever.
I could understand being upset with the coach. I can understand how they're using you. I can understand being worried about an ankle injury and not wanting to go back out. But boy, to just piss away a contract like that.
Yeah.
You do that in the middle of a game on national television.
It's not a good look.
You can't walk that back.
You know, I've seen people shriek in the middle of a game, but that was bad.
Normally, it's not one of the players.
Yeah, normally it's not someone that's trying to win the game, you know?
Yeah.
That was insane. Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
Hey guys, and welcome to the first episode of the 2022 Drunkenomics schedule.
Gosh.
It's weird to say.
I know.
Isn't it?
I can't believe we're giving presentations in 2022. This is insane.
Started 2020, now we're here, guys.
Yeah, literally from the bottom, and now we're at least here.
We started from like the lip of the pool, dove in, hit the bottom, and now we've surfaced. We kind of climbed out. Hopefully, we're not heading up to a diving board, right?
We'll see.
So
we'll see what 2020 has in store, but
hopefully, it's not 2020 part 2.
I hope not.
Hey guys, so welcome back to Drunkenomics, or welcome for the first time, the first Drunkenomics episode of 2022. I am your less gracious host, James Goldwater.
Yes, you are.
Joining me live is the more gracious host, back where he belongs, second week in a row, Mr. Aaron Wong.
Thank you. Thanks for that lovely introduction. I'm so happy to be here and I'm so happy to have a drink with you, even remotely.
Yeah, cheers.
As I'm in Arizona. Yeah. Cheers to, I guess, New Year. I don't know what else to say. But anyways, real quickly, I just want to give a shout out to our social media stuff at Drunkenomical on the Metaverse. Are they officially Meta yet? Have they changed the ticker symbol?
It's still Facebook and Instagram. I think
to me, it's always going to be Facebook and Instagram. Just like MySpace is always going to be MySpace, and Twitter is always going to be Twitter. But you can find us on all those things aside from the MySpace at Drunkenomical, DRUNKENOMICAL. From there, you can join the real conversation, join the real club.
Yep, follow us, like us there, and you can join in with other Drinkonomists and Econoholics. You can join our Discord, Drunkenomics Discord, where we have, it's generally a pretty good time in here.
Yeah.
But yeah,
Econoholics and everything, everybody talking to each other about bourbon recommendations, what they think about China and Russia and the Ukraine and Turkey sometimes, and of course our Aussie blokes.
Definitely some stuff that's
and then of course
definitely not
our Aussie
financial
blokes
advice.
bragging about how they got ranked the #1 drinking country in the U.S. in 2021. I just saw that this morning.
Come on.
So congratulations,
All right, well,
you Aussies. Sam Edges and Tim
Edges
the most
of the world.
book of them all.
You guys earned it.
Yeah, exactly. Congratulations. Thanks for sharing some of those drinks with us.
Thanks for drinking with us. Let's put it that way.
Yeah. With that said, join the conversation there. Tweet at us, shoot us DMs on Instagram. We're always happy to hear from you guys. Send us questions.
We try to get back here. I did see some pretty cool stuff from some of our guys. Some stuff they got for Christmas, some bar decorations, some other cool things. So it's been a pretty chill setup at this point. So
yeah, exactly. Thanks for tuning in and joining us for the new year. And with that said, I guess what's new in this New Year's? Well, I mean, this is just an update from what I saw at the end of the year last year. In other words, last week, Catbacks for tech companies is above their 5-year moving average, which I feel like I feel like it's pretty noteworthy. I don't know what exactly their capital expenditures are. Catbacks just basically means whenever a company decides that they want to expand on whatever project, I guess for accounting purposes, when they spend the dollars to build a new factory or to, I don't know, remodel something, whatever it is.
It's the purchase of what in accounting we call PPE. It's property, plant, equipment.
Yeah, but Catbacks spills into a bunch of other things too, right? I mean, it's not just PPE. Obviously, PPE is Catbacks, but
it's the major chunk of it.
Yeah.
So it's basically anything that's not going to be consumed in a year's time. It's anything that is expected to have a life, usually a useful life of three plus years. Which, if you think about it as a tech firm, if your major expenditures are on cloud computing and then like all the server racks and the server farms to like keep all that running, well, at a time when semiconductor chips are at an all-time high at a premium, of course, Catbacks is going to be up, even if you're just purchasing the same amount of
stuff. The dollar amount is going to go way up.
Historically, the dollar amount is going to be up. That being said, we do also know that places like TSMC, Intel,
They're all building these
they're spending
foundries.
huge amounts of money,
Billions
down
of dollars.
in Arizona, down in your neck of the woods.
Down in my neck of the woods, literally where I am. I mean, not literally where I am. Like they're like 40 minutes in that direction. But just because I want to know how it works for accounting purposes. So if they announce a $20 billion thing, and obviously they put the down payment for it, for accounting purposes, like when does the 20 billion in Catbacks get reported? Is it as it gets paid, or is it like if they take on the loan and then they pay it? You know, you know what I mean? So
generally, when the easiest way to think of it is we report it. It gets recorded essentially the instant it's realized or it's real. So if I'm Apple and I have the cash to just buy the thing, it can be capitalized, or it's right then. That's the expenditure. I had the expense. I can announce that I'm going to spend blank amount over the next 5 years, and then it's essentially each year as I pay for materials and stuff as I go. And so it goes, now if it's a
what if they like borrowed a bunch of money, even if it's from themselves? Like
so creating a note. So the moment I create the note, I don't actually spend a whole lot of money at that point, but I put this new liability on my books, and so when I put that liability on my books, I get a corresponding asset to keep my balance sheet balanced.
Go figure.
Yeah. And usually what'll happen at that point is I'll add immediately the property, right? So the first thing I'm buying is usually the land. So the land's value is there. It's not depreciating.
So under your assets, your real estate assets will go up.
Yeah. So I'd get that. So under my long-term assets, I would add the property, because that's probably what I'm taking the note for. As I build the building,
of course,
I'm going to show decreases from my cash, which is an asset, increases to my plant. So we're buildings. So an asset decreasing, another asset increasing by the same amount.
Right.
And as I put things in it, I either create a liability or I decrease my cash and I increase the equipment.
So like on a statement of cash flows, you'll see the outflows. So if you build a $20 billion foundry, such as what Intel or I forget which one, TSMC, one of those two is doing a $20 billion boundaries.
You wouldn't see it all at once. So you'd see it as the cash is actually being spent.
Okay.
So as the bills come due.
Okay. So even if they borrow $20 billion, you wouldn't see $20 billion go out?
Not all at once. So if I borrowed $20 billion from a bank to build this, I'm probably not going to see...
you're taking a note.
I'm putting the note on my liability side of things. On top of that, chances are I'm probably not going to take the cash and then go spend it. Instead, what I'm going to do is I'm going to tell the bank, hey, I'm buying this land. I need a mortgage on it, right? So I need a note on the land. And then they're going to go, okay. So the bank then goes and buys the land. Because remember, until you've paid the note, until you've paid your mortgage, the bank owns your house.
Yeah. So if you default on that, then the bank takes the collateral.
Doesn't matter if you've made one payment or if you only have to make one more.
Exactly.
The bank still owns the house. So
so you got to get rid of that liability, but at the same time, if you have the liability, but you think and you believe in yourself enough to invest it and make more money, plus the interest, you should do it. And companies like Intel and TSMC, they probably could.
Well, they know they're going to make money. They know that they need to do this. They know they're going to make money. TSMC has known that let's put it this way. They both already have plants in
Arizona.
Scottsdale?
Chandler. It's in
Chandler.
I don't know where TSMC is, but I know Intel is in Chandler.
I think they're both in Chandler.
They might both be in Chandler because Chandler, they've expanded this whole area in Chandler where it's just like there's these two gigantic factories to make semiconductors.
Yeah,
and I'm pretty sure but the thing is, I don't know if they're both owned by Intel. So that's
sure.
I don't say it with confidence.
So we know that they're just expanding their production facilities because they know there's a market.
Yeah. And then, of course, companies like Ford, Tesla, which I want to talk a little bit about because Tesla is up. I think Tesla's stock performance today was a gamma squeeze.
That wouldn't shock me.
Yeah, but I think just the demand, the rising demand for all that stuff is also what's driving the CapEx for these companies like NVIDIA and onsemi's and AMD and all that kind of stuff.
And because remember, if we think about it, NVIDIA, AMD, NVIDIA originally had a foundry. They had a manufacturing arm.
Right.
And then they looked at the numbers. They said it's actually a lot more profitable not to make the thing, just to design the thing. And so they spun off their foundry.
Right.
In retrospect, not maybe the best decision, but who knows? It seemed like the good idea at the time.
I mean, we'll see. To me, that's really noteworthy because I think when CapEx goes up, I think it's a really good way to.
I think it's usually a good indicator of business sentiment about the future. So think about it this way: you're spending your cash to expand your production for lack of a better term. And you only do that when you expect to be able to sell it. So
yeah, people are optimistic that the market's going to be there in the future and they're willing to spend and invest the money now. And generally speaking, narrow the profit margins, which I think is weird too, because Catbacks is up above 5-year moving averages. At the same time, profit margins are the highest it's ever been. So we'll see. I don't know if profit margins in the next quarter are going to be a lot thinner.
Well, we'll see.
Yeah, I don't know when the next earnings season is, but I guess we'll see then.
In February, we'll start seeing a lot of the Q4 stuff.
Yeah, there we go. So yeah, let's see what happens. Let's see what profit margins look like then.
Oh, yeah.
Yeah, and speaking of which, what was the other thing you want to talk about? Was it Ford?
We were talking about Tesla, and it was just that. So Tesla is up quite a bit today.
Quite a bit is a nice way.
13.5%.
Yeah, 13.5%, $143.
And it did that on the back of news that Tesla has had its best quarter and its best year ever in terms of delivering cars. Yeah, with what was it, 963,172, something like that.
Which is stupid, and it's trading at like this. Now it's trading at like a 1,000 PE again.
I mean, for reference, Ford in 2021, in fiscal year 2021 for Ford, they delivered approximately $1 million a quarter.
$1 million cars a quarter or $1 million?
Vehicles. A million vehicles a quarter.
I thought they did $500,000 a quarter, but I don't know.
I read it was average of $1 million a quarter.
Yeah, you could absolutely be 100%
delivered,
right.
Not necessarily sold, but delivered.
But like last quarter, so like this weekend, over New Year's weekend, a headline came out on CNBC saying Tesla had a record Q4 and they delivered 308,000 vehicles. Delivered, right? Not sold, but delivered, like you said. And does that warrant a 13% upside movement for the stock? I don't know. Does it mean that it's like that for every dollar of earnings, I'd be willing to pay $1,000 for? I don't know.
I would personally say I'm not. And for this is kind of one of those things to look at.
Too,
it's like,
but I missed out. I missed out on a lot of capital appreciation. I'm just saying.
It's one of those things where its context is really kind of critical on this.
Yeah.
Someone says, "Oh, they had a record quarter. Oh, good or bad? Good. Oh, okay. What did they deliver? Well, they were 308,000 cars. Is that good?
Well, let's look at industry peers and let's see what GM did and see what Ford did.
For them. Okay, well, let's look at other auto manufacturers.
Yeah.
Oh no, it's a piss poor.
Yeah, and that's usually what you do. Like when you look at like financials and it's like, okay, what's Bank of America's profit margins? 23%. Well,
is that good? Is that
I don't know if that's. I don't know.
So I do horizontal check.
Now it's like a JP Morgan, analysis. Goldman Sachs, Morgan Stanley. What are their profit margins? Oh well, Morgan's is at 19%. I don't know. I'm making up numbers here. Citibank is at 26%. It's like,
all right, so they're run of the mill. They're middle of the pack.
Yeah, and then from there, pick your poison, right? Like, look at other financial ratios and then pick your poison. But they all should be pretty similar. But when you look at like Tesla's numbers compared to their industry peers, it's not even close. Like their revenues aren't even close to Ford and GM's or Toyota.
Their proven manufacturing capacity is not there. The fact that Ford has now got almost all of Apple's electric vehicle guys working for them now also should say something. I mean,
and then look at their leadership, right? Like, is Elon Musk a better CEO than the Mary Barra and I forget her name, is Mary Barra and Jim Farley? Jim Farley's a Ford CEO, but like, is he a better CEO than them?
Yeah.
Because we all know he's a loose cannon.
I mean, like I said, we can go back 2 weeks ago and last week where he said, "I'm done selling my shares. I've hit the 10%. I'm done selling." And so the stock price went back up because people aren't going to buy in when you've got a guy who's just dumping shares. Well, then it turns out, no, he wasn't
dumping his shares. Yeah.
He still sold $1 billion more worth of shares.
But yeah, I mean, what I'm saying, basically the moral story is like, one of the reasons you buy a stock is what do you think about the CEO? But is Mary Barra and Jim Farley a better CEO or a worse CEO than Elon Musk? I'm not going to decide for you. You got to decide for yourself.
Make a decision for yourself.
So I just thought that was pretty absurd. When their stock shot up today, I was just like, what? Was this news this weekend really that good to warrant this kind of stock reaction?
It really takes me back to 2 years ago when we were just getting started and NVIDIA was on a tear in February. Do you remember that? Because NVIDIA was just through the roof.
They had a record Q4.
So it's this. So when that was all happening,
2019.
Like, oh yeah, no, NVIDIA, look at these numbers. I was like, right. At risk of sounding like a broken record, we sat here and we were like, why aren't people looking ahead?
Yeah, but obviously NVIDIA had to overcome their issues. So like, and it's also, speaking of great CEOs, Jensen Huang, fantastic CEO.
Oh yeah. NVIDIA. Well, the other thing is that helps NVIDIA is that, again, that cloud computing. all that stuff. Going into lockdowns, yeah, it turns out, no, that was pretty critical. So of course they're in great shape.
Right. Yeah. And obviously and it was also just demand for
for their products.
NVIDIA's products. Yeah. So like
hence the reason,
I mean, obviously they've overcome, but it's just like I said a million times, buying a stock is really just you're betting on the company's future earnings. That's why you buy a stock.
Yeah. You're betting on it being better in the future than it is now.
Yeah. And when there's a supply crunch and at the time, no real solution to the supply crunch and the stock still shoots up because of a previous misjudgment that people believe was out there, which was what was going on now with Tesla. Because it's, 308,000. Wow, we smashed expectations. Now the stock has to shoot up for some reason. I don't know. Does that make any sense?
Yeah, it's definitely one of those things.
Right. Yeah. And it's kind of like with NVIDIA, like, wow, their fourth quarter numbers were so good. Like we really just misjudged their stock price. And that's the reason why NVIDIA stock shot up in Q1 in February of 2020. Kind of like what's going on in the very first trading session of 2022 with Tesla.
But yeah, no, so we'll obviously get to see in 2022 with hopefully the supply chain easing. I did enjoy, I forget who it was, but someone in the Discord was talking about the supply chain. They said they were talking to someone else who described the supply chain not so much as like a chain that has like links, but more as like a massive spider web made of like toothpicks. And like when one breaks, it's all gone.
Yeah, that's actually
pretty apt analogy. I think
that's a pretty
it's very much that House of Cards.
Yeah, it really is. And it's weird because it's like, this toothpick is out of place and it causes this toothpick on the other side to be somewhat out of place too, which is weird because of everything being so globalized. It's so weird how connected the supply chain is. When something happens in Guinea, for instance, it creates this ripple effect to Australia, and then it creates this ripple effect to China, and then to the US, and then to all of Europe, and then to Russia. It's so weird how these things are connected. And speaking of which, we also had another question from the savings question. What was the savings question?
Boy. Synthetic Bjorn.
There we go. Yeah,
it's just ignoring the fact that we're asking for how to pronounce his name at this point. Is just like, no.
I just think it's because we're doing it correctly.
I will assume the same.
Yeah.
So he just kind of says, I need to rebuild my savings. What's the best advice for that for good growth? I'm gonna start with something really simple, and it's gonna sound stupid and basic, but it boils down to this: make a budget. Have a goal, know what you want to do, but make a budget, because you need to know what you have to spend, what you want to spend, and then what you're trying to accomplish. So like, and this is true for not just individuals. This is true for families. This is true for businesses.
This is Kevin O'Leary's thing.
Yeah, you just have to have a budget. So you have to have it, because the first thing is when you create your budget, you're going to have to sit here and you're going to look at what are you spending? What are you spending just to survive? And it's like, okay, this is money I have to spend. So we're at a point where we're like, oh, wow.
Just to be alive. This is what you have to spend. Yeah. And then from there, it's kind of like a business. This is what you have to spend just to be operational. And then from there,
all right, this is what I have to spend to thrive. And then,
and this is a page shot of Kevin O'Leary's book, which is, Kevin O'Leary, the guy from Shark Tank, if you don't know who I'm referring to, but he's on Shark Tank, he's on CNBC all the time. But his whole thing is, step one just means like, whatever you bring in, hopefully that number just needs to be more than what you're spending.
To exceed what you're spending. Yeah, that's absolutely true. It sounds so, like I said, it sounds so stupid. It sounds so basic, but the thing is, most people, there's a great line in Margin Call.
Yeah.
And it's that scene where they're on the roof.
Oh yeah,
and,
with Paul Bettany.
And Paul Bettany. And did you really make
$1.4 million or however much Paul Bettany made? Yeah.
How'd you spend it? And his line was,
I was like, first off, half of that goes to the tax man. So,
and so
now I'm really working with
what's that,
800 grand.
One and a quarter? Yeah. I said 400 to my folks back. I said 200 to my folks back home, house, car. This is this.
Hookers and coke.
Really? And he's like, but Zach Quinn looks at him, he's just kind of like, really? You spent all that money? And he just goes, yeah, you learn to spend what's in your pocket. Yeah. It's that line right there. You learn to spend what's in your pocket. And, I'm guilty of this. I'm sure we all are.
Of course.
But in fact, let me rephrase that. We all are.
Yeah. I'm still on vacation,
if you're not making conscious decisions about spending your money, then that's what's happening. That's kind of where your ability to save gets sucked away. It's where it's where you don't show that discipline. So when you start to, so kind of like some of the easiest ways, you can, when you do direct deposit and payrolls and stuff, you can
a savings account,
a percentage of it sent to a savings account instead of to your checking account. You can have
that way it's not in your pocket, right?
Yeah, so that way it's not in your pocket. It's automatically taken away from you before you even think about it actively.
So Keith Zimmer, right? Keith Zimmer?
Yeah.
Yeah, so for those listening, Keith Zimmer, if you guys, there's no way you guys know who he is, but he's one of the associate athletic directors for the University of Nebraska. When I was on the golf team at Nebraska, this guy was very influential to me, and he told me something that I'll never forget to this day, but his motto was pay yourself first. And when he says pay yourself, what he meant by that was whenever you receive a paycheck, pay yourself first. How do you pay yourself? You put money into a savings account because you're actually like stashing that away, and you're learning to live off of everything that you received less whatever you stored away in your savings account. So he's like, always, you take a paycheck, put a portion of that into your savings account, and just figure out how to live off of everything else.
Yeah.
And I thought that was fantastic advice.
Yeah, no, it definitely is.
First.
Because that's what you need to do. I mean, there's also like the apps, right? Like there's those stupid apps that are like, oh yeah, we'll round up every time you spend, we'll round up to the next dollar, and we'll put that.
Yeah, that's Ashton Kutcher's thing.
So there's a bunch of things that do stuff like that. Yeah. So that's another way if you're really looking for ways. Yeah. For me, the big one is set a goal for yourself essentially, and it's either I want to put aside a percentage or I want to put aside a flat rate amount every period. So every paycheck, every
paycheck,
every
I want to
month,
put $500 of that into your savings account or whatever it is.
Just something like that. But like I said, you're gonna have to create a budget. You have to figure out where your money's going, so you can figure out, okay, what do I have to spend? What do I just want to spend? And then is my goal attainable? So obviously you have to set a realistic goal. And if you get to a point where you realize, man, saving this is really, really easy, kick your goal up. If you really want, if that's where you're at, kick the goal up. The periods of your life, if you look at kind of the economic model for how a life is really supposed to be lived from just a purely numbers standpoint, essentially from the moment you enter the workforce, you're supposed to spend, let's say that everyone at the age of 20 is when you start working. And that's just an average of 18 when you get out of high school ballpark and 22 when you graduate with undergrad from college, university ballpark, right? So not everyone does the second part. Of course, yeah. Not everyone does the first part. But let's just call it an average age of 20. And let's say retirement age in this country is still 65, which I think is too low, but that's a different issue with life expectancies. You're supposed to spend that 45 years of your life saving money.
So you're supposed to.
Now it doesn't happen that way, especially not in the US. But the economic model says you spend that first 45 years in what's called the saving period. Mm-hmm. And then when you retire or stop working totally at 65, let's just say you enter what's called the dissaving period, which is to say all that money you've saved the last 45 years, you're now spending more than you're bringing in because you're not bringing money in anymore.
Yeah, the theory is, why did you save it? Because at some point you don't plan on working, you plan on just doing whatever you want. You need money to do whatever you want. So here's the money that you saved up the last 45 years.
So you spend the first 2/3 of your life saving and the last third of your life in dissaving. And I realize it's a very simple model of it, but so that's what I'd say. Yeah. Now,
no one wants to stop working. That's the reason why. Yeah, but whatever. Yeah.
Now this brings us to perhaps a more nuanced version of this. Like the savings account is the very simplest way to do this. Yeah. But there's also some really cool tools you can use to save money for that dissaving period in life.
Yes, there are.
And it's the IRA system, or the IRAs, at least in the U.S. specifically.
Yeah.
Overseas, you have different types of pension and saving schemes.
Yeah, I mean, every country has some sort of a retirement account that, exactly, like a tax sheltered account that you can put money in for retirement. Maybe other countries do have what is called an IRA, but I think in Canada, because I remember someone was talking about that in our Discord, it's called something else. But essentially, why do you save? You save because at some point in your life, you don't plan on making as much money as you're spending. Hopefully by this point, your house is paid off, no student loans, debt. You pretty much have no debt, and you need to start dipping into that pool of money that you had saved up and worked hard to save up throughout the years.
Yeah. So I looked and the IRA is what it is in the US. In the UK and in Australia, it's just a pension scheme. It's just what it's called.
They call it a scheme? Wow.
Well, scheme just means plan.
Yeah. Yeah, like the offensive scheme for football. Like this is the game plan. This is the offensive game plan. Right, yeah. But yeah, I mean, if you put money into a savings account, it's not really going to grow. I mean, I don't know if there are savings accounts that you can buy securities in. Usually, to my knowledge, you put money into a savings account, it just earns interest at a very, very low rate. You're not really protecting that money from inflation.
If you want to, I'll try and find the video, and when I do, I'll post it. But there's a very fun Clark and Daw video
Oh,
which
gosh.
is the front fell off and some of the other guys. But one of them is that, what are you? Oh, I'm a major bank. And he goes, what do you do? He goes, well, you give me your money. It's secure. And because you give me your money, I'll pay you interest. How much you pay me interest?
Yeah,
About the same amount I'm charging you in fees.
Yeah, exactly.
So
It's Clark and
it's
Dahl
very much
I know Tim Major loves Clark and Dahl.
so do I.
Yeah, I know. I mean, how do you not love Clark and Dahl, man? But like, they're so funny, and it's like everything they
It's
say
a little
is true.
too on the nose at times, but
It's way too on the nose, but it's really thought provoking, which is nice. That's what you want.
the problem is that it's a little too on the nose.
It's a little way too on the nose. Yeah, a little, yeah. But like a savings account, you're not really growing your money. It's just sitting there.
I mean, it's growing some, but it's not.
Yeah, but you're losing buying power because of inflation.
I mean,
so
let's put it this way. A bond is going to get you a better return in most cases than a savings account.
yeah, but even then, government it depends on the bond too. Like some corporate bonds might actually help you hedge against inflation.
Now, the plus side of the savings account is that up to the first $250,000 in the U.S. specifically, it's
FDIC insured.
Between that and your checking, it's insured by FDIC.
So
the one kind of piece of advice I will give is if you have $250,000 in cash between checking and savings account in a given bank, great.
Fantastic.
If you have more than that in cash, so say you have $400,000 in cash and for whatever reason, you're just not looking to invest it in something else, which I don't quite understand you, but you should probably go to a second bank and open a second set of accounts because the FDIC covers, as I understand it, protects you one time in a bank.
Oh, really? I thought it was different if it was a checking or a savings account.
No, it's a flat amount.
Oh, okay. I didn't know that. I thought it was different for.
So Aaron Wong at Wells Fargo is protected for $250,000. Now, Aaron Wong can have two different accounts there, but guess what? It's still only $250,000
So
total.
If I have more than that, which I don't, but if I did,
then maybe running over to Citi or Chase.
Or Citi,
because Aaron Wong is insured for $250,000 at Wells Fargo, and Aaron Wong can be insured for $250,000 at Chase
or Citi.
So suddenly, if you go to every different bank because you have the cash, and remember you want to be protected. Now,
of course,
in the event that this is actually coming into play, there's bigger issues.
Yes,
but
there are.
You could federally insure more cash by going to more institutions. That's what that was.
It's kind of like speaking of IRAs, right? So if you save, you can save either in a savings account. Probably won't actually help you hedge against inflation, but if you put money into an IRA, now we're talking. Now you can buy stocks. Now,
absolutely,
if it's self-directed, right? So you choose your own securities. You can buy ETFs. I know a lot of people in IRA accounts, and IRAs are generally long-term thinking. A lot of people do day trade in an IRA account just because it's tax sheltered, which is totally acceptable. If that's your goal, open up an IRA, protect yourself from taxes, and day trade in it if you want. It's up to you. But
look, if you ask me, IRAs can be abused, and I think that some of these loopholes need to be closed because,
of course,
you've got certain billionaires who have made way too much money through their IRAs tax free.
Yeah, well, it's the whole traditional and Roth IRA conversion that we've talked about before. But I mean, but basically, what is an IRA? IRA stands for an individual retirement account.
Yep.
And basically, the rule is you make money. If you make under a certain amount of money, you can have a Roth IRA. You can deposit $6,000 into a year. Traditional IRA, you can also deposit $6,000 into a year. Now, however, if you deposit $3,000 into a traditional IRA, that means you can only deposit $3,000 into a Roth. So combined, you can deposit $6,000 a year until you're 50 years old, and then when you're 50 years old, you can do
$7,000.
It goes up to $7,000
more now.
Yeah, it goes up to $7,000. At one point, it was $65,000, right? So, like when you turn 50, you can do $6,500 between the two accounts. But
now it's $7,000. It's $6,000 or $7,000.
It's $7,000. Yeah. So when you're 50 years old, anytime from you're 50 and older, you could deposit up to $7,000 in either your traditional or your Roth. Or if you want to do both, the combined amount needs to be $7,000 or less.
This is just so you're wondering what that 15-year period is called. It's called the catch-up period.
Yeah,
that's all that is.
As soon as you're over 50, yeah. The thing about IRAs, though, is you generally can't access the money until you're 60, or actually more specifically until you're 59 and a half.
Yes, so, not without paying a penalty.
Yeah, exactly. There is a list of reasons that you can't access, like if a medical emergency, first-time home buyer, schools, I forget what else. I mean, it's a long list. It's like a list of 30 reasons.
There's a few that they put in there because they realize, well, it's probably better for the economy to let people make these other investments in themselves that theoretically increase their future earning power.
Yeah, exactly. So, IRAs, like I said, you can day trade in it. Day trading rules still apply. You need more than $25,000 in it to actually be able to actively day trade. You got to get margin, all that kind of stuff. You can have margin privileges, but you can't actually trade on margin in IRAs.
Yeah.
But generally, IRAs, you put $6,000 a year into it and you buy an ETF and you let it sit there for a long time, or you buy a mutual fund, you let it sit there for a long time, or you buy like a mega cap tech company.
Yeah.
Or if you want to gamble on a penny stock because you don't have to pay capital gains, and if the stock does take off, then congratulations.
Mm-hmm.
So yeah, you can buy whatever you want in an IRA account.
Yeah. So the thing about IRAs is that they're not employer based.
Yeah. They are individual accounts.
They are individual decisions, hence the individual and the IRA.
Yeah.
So these are separate from 401k and 403b retirement plans, which are employer programs.
Yeah.
So like
403b,
a business would,
403b is like if you're a police officer. Yeah. If you work for the government. Yeah.
401k is is generally a defined contribution employer matching plan of some sort. Which I guess I missed this part. I wasn't thinking about it earlier, but yeah, if you're ever working and your employer has some sort of a match, a retirement match, it is irresponsible of you not to go at least to what they'll match. So if they say they'll match 5%, you need to put 5%. Yeah. You really do, unless you just absolutely can't do it. But it's free money at that point, that saving period in life.
Yeah, I know some people that became millionaires making $40,000 a year, but because they maxed out their 401k every single year when they were like 60 years old, they were like, "Oh my God, I have $1 million in here. What the heck happened?" Yeah, I'm not saying it happens to everybody. I'm just saying it can happen.
As Warren Buffett said, "There's nothing in the world quite so powerful as compound interest."
I'll say
kind of how that works. So now that being said, if you have that 401k or 403b. It affects your adjusted gross income, your AGI, your modified AGI, which can dictate how much money you're able to deduct when you contribute to the IRA.
Right.
So when it comes to IRA contributions, you are capped at $6,000 or $7,000, depending on your age. That being said, in some cases, your contribution essentially is tax deductible. You don't have to pay taxes on it when you make the contribution.
Yes, exactly.
Now,
if theoretically, if you deposit $6,000, you make $70,000 a year. Can you deduct that from your $70,000 a year AGI?
Yeah. So your
AGI becomes $64,000. Is that the way it works?
How much you earn?
It's obviously a little bit more convoluted than that. Yeah.
Yeah. It all depends on how much you earn. So I'm looking at the numbers for 2021 right now. I don't think they've changed all that much for 2022. But if you are single or head of household, if you make $66,000 or less than the full amount, you I don't know. Here we go. 22,000. I found 2022s. If you make $68,000 or less, whatever you contribute, you can take the full deduction, right? So if you contribute $6,000, your AGI, you can reduce your adjusted gross income to $62,000. It's like you didn't earn it because you're not taking, well, you are in theory, but you're pushing it away to future you.
To when you're at least 60, or 59 and a half.
If you make between $68,000 and $78,000, you're going to see a proportional deduction.
Oh, okay. That's good to know. It's good to know the latter.
Yeah. And then if you make more than $78,000 a year, you can't deduct anything. You can still make the contribution, but you can't deduct the. So the pro is on that. The pro is on that. If you pay the taxes on it now, you don't have to pay the taxes on it later.
And that's why you have an IRA. So you don't have. Well, I think this is where we go into the different types of IRAs. So there's the Roth and the traditional, right? So Roth IRA, when you put money in, it gets taxed. It's taxed right away, or you have to pay tax on it. I don't know what exactly the rate is, but I think it's taxed as it can't be taxed as ordinary income. Can it be?
A traditional IRA,
and then a traditional you pay
is tax deductible, but you pay taxes when you take the money out.
Pull it out, yeah. Roth, when you're 60 years old, IRA, you don't pay taxes when you pull money out.
A Roth IRA is not tax deductible. Qualified distributions are tax-free.
So when you're 59 and a half or older, it's qualified distributions at that point.
So whatever your investment's gain was, you do not have to pay tax on. But when you start to wind down your initial investment position, then you start to pay taxes on that. Okay. And I know that sounds really weird, right?
Yeah, well, because your contributions, you still have to pay taxes on.
Yes.
Like whenever you can. So that's basically the big difference between a Roth and a traditional is one, first of all, if you make too much money, you can't have a Roth. You can't contribute to a Roth, at least. You can have one if you've made one before and you had contributed to it, and then now you gotten a bunch of pay raises, and now
yeah. So essentially, right now for 2022, it's if you make more than $144,000, you cannot contribute to a Roth IRA.
Is that if you're married filing jointly or if you're single?
No, married filing jointly, I think it's 208. It's 214,000.
I know it starts with a 2. Yeah. So if you're married filing jointly, you can't contribute to a Roth if you make that much money. If you're single, 140,000, I think is what you said, right?
Yeah. Yeah. Is where it stops. Now, the phase out range starts before then.
Exactly.
So essentially, this is if you're single and you make less than $125,000, you can contribute to a Roth IRA.
Yeah. For a traditional IRA, I don't believe there's a limit to how much you can make to have a traditional IRA or to contribute to a traditional IRA.
No, it's just there's a phase out for the tax deduction.
Yeah.
That's it.
Yeah.
Still make the contribution.
Yeah, and I think the second big difference, I think the biggest difference between a Roth and a traditional IRA is when you pull money out of a traditional, you pay taxes on that. When you put money into a Roth is when you pay taxes. So,
yes.
I guess another way to say it is contributions get taxed into a Roth. Distributions get taxed in a traditional.
Taxed out of the traditional. Yeah.
Out of the traditional.
Yes.
Yeah.
Yeah. That's I believe that's what I said earlier, but you put it much more succinctly.
Yeah,
so I'll play it.
Thanks. I mean, I'm more gracious this week, so just not bragging, obviously, not bragging at all. I'm just saying. I'm just saying. So those are the two main types of IRAs. I guess from there, if you really want to get into it, there's simple.
There's two more.
Yeah, there's
simple
SEP, and then there's
the simple.
Yeah.
The SEP is for self-employed individuals, so contractors, freelancers, small business owners.
Exactly.
It behaves, I think, the same way as it behaves just like a traditional IRA, but the contribution is limited to 25% of compensation or $61,000, whichever is less.
61,000 now for 2022. That's the number. Oh wow! Because I was used to seeing 59. Was it 59.5? I forget what it was.
I think everything went up about $2,000. What it's looking like from what I'm seeing.
Yeah, except for contributions to Roth and traditional. But yeah, SEP IRAs, you can contribute 61,000 now. Wow, that's insane.
So the other thing is with SEPs is that if you're the business owner, you can deduct contributions on behalf of employees.
Oh,
if you
nice.
If you set up a SEP IRA for your employees, you can deduct contributions on their behalf. They, however, cannot make any contributions to the account, and the IRS will tax them when they withdraw as income.
Yeah, well,
because they never made contributions, right? Someone else did.
Yeah,
and don't took the deduction when they did. So
yeah, and it's kind of like 401ks. Don't you get taxed on 401ks if you start distributing money from the 401k? Obviously, if you roll it over, they don't get taxed. But if you distribute money from a 401k, don't. Taxes. Yeah,
401k is you don't pay any taxes on any money contributed or any gains, interest or dividends, until you begin to withdraw from the account.
Yeah. So like a 401k is essentially like, if you work for a mega cap company, they set up a 401k for you. A SEP IRA is like if you work for a small business, but then again, you also kind of you run it yourself.
Well, the SEP is you are the small business.
Yeah. So you are the small business. And it's mainly geared towards businesses with less than 100 employees, right? I think that's what it is.
Yeah. You start to run into, the tax. When you really start to run into the tax obligations and other benefits, once you get big enough, like a SEP IRA isn't the most lucrative way to go. Like there are incentives to go with other plans and tools.
Gotcha. So once you get to that point, is that when the simple IRA becomes more, I guess, rational or appropriate?
So simple is it's another acronym, and it's the self-employed. It's for small business and self-employed individuals, but it's the savings incentive match plan for employees.
Yes.
Simple, right?
Savings incentive match. Yes. Seriously, so simple. Savings incentive match plan.
The pure difference here is that employees are allowed to contribute as well.
Yeah, exactly. So this is, I guess, more like a 401k than a SEP IRA. So basically, an employee can contribute into their simple IRA account, and then the employer can match up to.
I think it's $14,000. Is what
14,000. I think I don't know why 19,000 was sticking in my head, but I think that might be once you reach the catch-up contribution point, it's up to 19,000 or something like that. Yeah, no, it's 16.5. Sorry, my bad.
17 now. So the catch-up limit is 3,000 on top of that. So now at the same time, if you look at that, it says that in a simple that contributions are deductible, which pushes you into a lower tax bracket now, but when distributions come out, you're going to be paying taxes then. Right. So think about with 401k, it's all the same. 401ks, IRAs, essentially, if you're putting the money in now and you're not paying taxes, you're paying it when you take the money out.
Yeah.
If you are paying taxes now and you put the money in, you're not later.
Yeah.
So it all depends. It says, right, there's one of the really fun things when I took federal taxation.
Oh gosh,
was
your favorite class ever.
Actually, I did enjoy it, to be fair. But when we took taxation, tax avoidance strategies was a big portion of it.
Yeah.
How do you do it? Oh, well, you distribute your money this way. Instead of salary, you pay a dividend. Instead of paying yourself, you make a retirement contribution.
Yeah,
it's
exactly.
all just, well, what do I do to get myself bumped into a lower marginal bracket so I pay less tax? Yeah. And as long as it's legal,
it's encouraged and it's patriotic.
Not only is it is absolutely encouraged. In fact, it's encouraged in tax court.
But yeah, this is where I want to talk about RMDs as well. So RMD stands for Required Minimum Distribution. I don't know who that is listening is above 72 years old, but if you are above 70, yeah, there we go. So if they have a simple SEP or traditional IRA, you have to pull money out. The government makes you pull money out. Why? Because when you put money in, you got a tax deduction and you didn't pay taxes on any contributions you made into those accounts. So of course the government wants theirs. And when you reach 72 and a half, you have to start draining the account.
Right. So you're allowed to at 59 and a half. You're allowed to start at 59 and a half.
Yes.
But at 72,
there's a certain percentage.
That's when they go, all right, come on.
Exactly.
You got to start taking something.
So, and if you don't have the cash in there, for example, if you have $100,000 in your traditional IRA and all that is tied up in some stock, you're going to have to sell a percentage of that stock, whatever you need to sell 2 days before the last day of the year. And then the last day of the year, you got to pull that money out of the account.
Absolutely.
And I say 2 days because of trade settlement. Yeah.
That's generally why the last few days of the trading year, so the last few days in December, you tend to see markets trend down. People are pulling their money out,
or at least sideways. Yeah, just because
they're going to cash. Even if they're not pulling it out, they're going to cash.
Yeah, but that's just because like all these traditional IRAs, everyone's like, okay, what's my RMD at? Oh, my RMD is at $20,000. How much cash do I have? Oh man, I only have $7,000. Okay, well now I got to sell $14,000 worth of stocks. If you multiply that by 100,000 accounts.
That's a substantial sum of money.
You know what I mean? So,
and the other thing is, and you also have a lot of people who are going to start sitting here and look and go, well, guess what starts on January 1st?
Tax season.
It runs through tax season.
Yeah.
There are people sitting here going, well, I'm going to have to pay taxes. I know basically what I'm going to have to pay. Let's get the cash together.
Oh, fun fact too. I can also pull that from my Roth IRA. Not a bad idea. If it's something you can do. I'm not saying that you should or shouldn't do it, but there's something that people can do. But yeah, I just wanted people to know that RMDs are a thing. The very first year you turn 72, I think you have a longer period of time. The first year you turn 72 to pull money out. So I think the year you turn, so if I was turning 72 in 2022, I would have, I think, until 2023, April of 2023, to pull out my RMD for 2022. And then, of course, in 2023, that year, I have to pull out my RMD in 2023 as well.
Yeah.
And as far as contribution deadlines go, in case people are wondering, you have until April the next year to contribute for the current year. So I know that was really confusing, but if I wanted to contribute into my traditional IRA for tax year 2021, I still can. If I haven't done so already, I have until April of this year of 2022 to do that. My
honest to God reasoning for that is that I have a sneaking suspicion it has to do with the fact that it's tax season. And people are going to sit here and they're going to go, the government is not necessarily the most efficient thing in the world, but it does understand that it does have a little bit of understanding when it comes to the fact that certain things, just because the calendar ends, the rest of the business world and the economy doesn't. And so it understands that you might be at a point where it's like, look, I had a transaction that went through, but I didn't have creative and constructive control of the money for whatever reason. So I wasn't able to make my distribution. So despite I have income and transaction from November of 2021, I didn't receive the cash until February of 2022.
Yeah.
I would have made a contribution had I had the cash. I can't just go to my IRA and see like, hey, I just did this big thing. And when the cash gets here, I'm going to put $5,000 in. You actually have to have $5,000 to put in, right? So it's they're giving you it's a grace period for stuff like that.
Yeah, but it also gives you a chance to
the ability to look at your taxes and go, ooh,
this is my tax bill. How do I not pay this much? Well, have you contributed to an IRA yet? Yes or no? No? Okay, well, here you go. Here's a chance to deduct some of it depending on your income bracket and all that kind of stuff.
Yeah.
And then another thing, I'm saving this for the end just because It's a little bit morbid, but it's a reality. It happens more often than not. But what happens if you have an IRA account and you don't pull all of it out by the time you die, right? I'm sorry, it's morbid.
But unfortunately, it's a fact
something that
of
happens,
life.
right? So let's say you have a traditional IRA and you start taking distributions because you're 72 and a half and then kick the can at 80, but you still have money in your traditional IRA. What happens to that is it goes into a beneficiary IRA account and it goes to the next of kin for the most part. Or if you have a designated beneficiary, it goes there, right? So it can break up into 4 different beneficiary accounts.
I mean, it
can go up to however
depends on how many beneficiaries you've
you
listed.
can have 10 beneficiaries, right? So it would go there, and obviously the government still wants theirs, right? It's weird. Like, you'll be dead and you still owe taxes.
Yes. I'm sorry.
It's weird.
Speaking as the government, I'm sorry. Was I not clear?
Yeah, exactly.
Pay me my money.
Yeah, they've been talking to dead people like this, but yeah. So basically what happens is, let's say you're 72, you start pulling money out of your IRA and you still have 100,000 left in there by the time you pass away at 80. That $100,000 goes into a beneficiary IRA account. Let's say it goes to your kid. Now your kid has 10 years. So as soon as it gets moved over, I think there's like a grace period of like 2 years or something like that. And then there might be, I don't know, I could be way off on that. But I know there's a 10-year mark in which the traditional beneficiary IRA needs to be drained. So every year that the traditional beneficiary account is open, there's a RMD and that goes higher and higher and higher. And then eventually the 10th year, it has to be 100%.
Yeah.
And the taxes need to be paid. Yeah.
And the reason for that is, generally speaking, you would expect the next of kin to be a spouse. Mm-hmm. And then if you're dying, you can generally expect the spouse to probably also become deceased within 10 years. That's morbid. But you'd expect that similar age is similar. Yeah. You expect similar morbidity and mortality. Yeah. Similar M&M.
But but the thing is, the government's like, if you contributed all those years and you have $100,000 in your traditional IRA, the government still wants their portion of the distribution.
Have you ever seen the John Cusack movie Better Off Dead?
I don't think so.
It's one of those 80s movies where he has like a muscle car and he goes like snow skiing. Oh my God.
Yeah, I love this. That style is obviously very outlandish, but I find it very entertaining.
But the entire thing I'm getting to is there's this little kid, the newspaper boy, and the kid the running gag the whole movie is this kid struggling to be like, give me my $2. Just like chases him down a mountain.
That's the IRS.
Chases him like, exactly. Give me my $2.
They're going to haggle over your traditional IRA over pennies.
Oh, absolutely. Yeah. They're going to get their pound of flesh.
Exactly. And speaking of dying, this episode, I think, has reached that point. Good time to pull the plug, don't you think? This presentation lived a good life.
That's how we go out. I'm no doctor, but
yeah,
he's dead.
It's been pronounced dead. But with my dying breath in this presentation, I just real quick want to say Happy New Year's to everybody. Thank you so much for sharing a drink with us this early on in the new year. Wow, what a time to be alive. Please find us on social media, interact with us, tell us things. Whether you like us or dislike us, I want to know. I especially want to know if you dislike us. I've always been curious to know what the flaws in our presentation are. And then from there, you can also help us carry our legacy by...
you can definitely check out some of that merch at shops.myspreadshop.com.
No.
Nope. Wow. I keep trying to pin it to the bottom and it always goes
Presentation
away.
1, it's already been misquoted.
It's a whole new year and I've forgotten the basics.
Dude, it's a whole year of being drunkonomical, man. Sometimes your memory just slips away. But I have it right here too. So, and I don't have it committed to my memory and I probably should, but it's on my notes right here, drunkonomics.myspreadshop.com. We have hoodies, other hoodies.
Hoodies, swag.
hoodies.
I promise I'm actually, I think we're very close to being able to link up some glassware. So we'll see where that goes. Yeah. So you guys can drink in style. I know you can get coffee mugs at our current situation, so you can be all set there.
So the Irish coffee drinkers of this world. I mean, come on, man.
Absolutely. I mean, that being said, if you've got too much merch or you don't want everyone to know how awesome you are from your merch, I guess, or from your clothes, from your swag, if you want them to have to figure it out by hook or by crook, then you can always check us out at patreon.com/drunkonomics.
Yes, you can. Where you can what's it called?
Help us keep
the ice cubes cold.
Help us keep the ice cubes frozen, the liquor cabinet stocked, and the lights on.
Yeah.
Pro and con, the lights are on, which means we're able to record. So then again, if you're listening,
at the same time, we also need the liquor cabinet to be stocked too.
Whether the lights are on or off.
Yeah, that makes us a little bit more bearable. But yeah, seriously, check that out. We appreciate you all if you partake in any of those activities. We appreciate you greatly. And with that said, I hope you guys have filled and killed. And please continue to play chestnut checkers as we head into 2022. Don't brag, just say. And last but not least, please
make 2022 the most drunkonomical year yet.
Cheers, my friend. Cheers to Drunkonomical 2022.